Now, capital, of course, is crucial in getting all these great FinTech ideas up and running. Our next moderator couldn't be better placed to lead that panel. Eileen Burbidge is a partner at Passion Capital, and they are the leading early-stage technology venture capital investment firm in Europe. Eileen is also the Treasury's special envoy for FinTech, so I think you'll probably agree with me that she's extremely well placed to lead this panel and look at how you get those wonderful ideas put into practice. Please join me in welcoming to the stage Eileen Burbidge.
Thank you. Thanks very much. Thank you very much. It's really a pleasure to be here because I actually vividly remember the first Global Summit in 2015, and it is fantastic to see the event go from strength to strength, which of course I think very naturally reflects that of the UK FinTech ecosystem and all of the companies that actually we're going to be talking about today. We were introduced as being a panel that's going to talk about investment capital going into FinTech here in the UK. But actually, some of you may have already seen there was an earlier conversation with investors that was in the other room. And so we're going to focus more on this next sort of 40 minutes on beyond the capital and what else is really important for a flourishing ecosystem here in the UK for SMEs as well as incumbents. And I'm really pleased to have a great panel behind me because I'm not going to stand here and pontificate to you, but we're going to hear from members of the ecosystem itself. And so if you can please join me in welcoming my panelists. They are Chris, Dan, Steve, and Rhydian. Thank you, gentlemen. It's good to see you all.
And you.
So as you heard me say, I think we're going to try and go beyond just the capital, because I think there's been enough conversation about what VCs are looking for, how to get the investment capital, what's bringing it into the UK. And I think we want to talk based on all of your sort of very, very relevant expertise about what's even more important than those dollars or than those sterling notes. And so before we do that, if I could ask each of you just to introduce yourselves, maybe within a minute or so, and talk about your perspective, sort of what it is and how it reflects on the ecosystem, whether it's as an investor, a builder, an entrepreneur, and so forth, just to give context then to the conversation we're going to have. Starting with you, Chris, please.
Thanks, Eileen. My name is Chris Skinner. I write a daily blog at thefinanser.com, and I've been doing so for over 11 years, all about FinTech, and the author of a number of books, the newest one which comes out today.
Which everyone can sign, or you're going to sign.
I'm doing a signing in the delivery hall afterwards of Digital Human, which is why I'm wearing the tie. That's the cover of the book.
Brilliant. Dan?
So I'm Dan Cobley. I'm the partner in charge of FinTech at Blenheim Chalcot. We're a venture builder, and what that means is that we typically start companies from scratch. We support them through the early stages with a combination of capital, but also support from the partners and a wraparound set of services that help them get on their way very early. And we stick with those companies with majority ownership, typically through to exit. And we feel that what that does is can help really get startup businesses to focus on the core bit of building their proposition for the market much more quickly and in a more focused way than if they're distracted by the typical rigors of fundraising processes and the admin of setting up a business. Brilliant.
Thanks. Rhydian?
Yes, good afternoon. My name is Rhydian Lewis. I'm the founder and CEO of Ratesetter. Ratesetter is 8 years old. I set it up with the purpose of allowing normal people to earn more on their money. We are otherwise known as a peer-to-peer lender. I think the FinTech has sort of come and swept us up in the last 5 or 6 years because we see peer-to-peer lending as one of the kind of early stage parts of FinTech, but now there's obviously a whole broader ecosystem, which is extremely helpful. And I would say my sort of take on a lot of this is that we are very, very focused on staying the course and getting that right mixture of speed but also patience so that we hopefully can take a business right from startup through to sustainable business that makes a long-term impact in finance.
My name's Steve Lemon. I'm co-founder at Currencycloud. We set the business up in 2012. Our philosophy is predicated on the concept that even now it's still too expensive to move money across a border. We took the view that we would set our business up as a utility, servicing banks, brokers, and some of the fintechs that have been on stage today already, rather than servicing the end customer. We believe in making the payment processing as simple and transparent as possible to allow our customers to focus on building great user experiences.
Brilliant. Thank you all. And so I'm always obviously partial to hearing from the entrepreneurs first. That's all right. So I think with Rhydian and Steve, if we can start with the two of you, given that you have had the benefit of investment financing, and I think now's not the time to talk about your battle scars, about how difficult or easy that might have been, because you're clearly in a place now where you have the luxury of attracting investors, given what you've built over the last 7, 8 years, for example. But given now your hindsight and your perspective on that process of raising investment, what do you think is more important, or what do you think comes with investors and that capital that helps you even more constructively than actually the money?
Well, I think it depends on what you choose. I mean, we've chosen either deliberately or just by chance a course which is all designed around finding the perfect mixture of retaining some of the business ourselves as founding management, giving employees a route to ownership in the long run, bringing capital in on the basis that it's going to be a long and patient journey needed, and also a focus on governance and kind of external boards and so forth. So Ratesetter looks a bit like a sort of mini public company. And that's one course, and I think that if you get that right, that's a really kind of pleasant journey, and I think everyone gets what they kind of want: employees, customers, shareholders in the long run, boards, and so forth. Where it can become perilous, I think, is when if those lines of communication between all those different stakeholders get quite stretched. Yeah. And so suddenly the employees don't know quite how the journey fits in with what the shareholders think, and the shareholders aren't quite sure who the board are, and so forth. And because you're going for quite a scattered form of power, deliberately, it needs to all hang together. And that's where a VC element, or more kind of Dan's world of being venture builders, where you keep it tighter, in a sense the capital comes with a package of administrative support, recruitment support, and you're just allowed to get on and build your product, which is what a lot of entrepreneurs love doing, is the product. I think it can be very powerful. It might have a shorter cycle, if you like, and it requires somebody in the business to care or want to do the long run thing. But in terms of product delivery, I think that can be highly effective. So they've just been my sort of thoughts about the difference between going for this kind of long classic route versus the kind of extremely effective product delivery route.
But I've heard you say patience is kind of the key for you, right? So patient capital and having patience for that. And Steve, I don't know if you have a different point of view, but you've also raised money from investors that are not just in the UK, from the US, from Germany, from Japan. Do you have a point of view on what the merits are from raising internationally or domestically or mix or?
Yeah, we've been very fortunate, actually. We've got some fantastic investors, and it's interesting you mentioned patience. I think if you get the right investor, it doesn't matter. Money is just money to grow the business, but I think it's the business partner that comes with it in your investor can give you so much, from helping you from a business development point of view, leveraging the ecosystem and being leveraged in their ecosystem, the corporate governance, better investors and better run investment houses, better run VCs will in turn drive you to run your business better, and better run businesses grow more quickly. But it's the partnership element. If you've got a good, patient board of investors, it's as much as how they handle things when things aren't going as well as they could be, as when things are going well. Having a patient, understanding investor is really important. Okay.
And so maybe, Dan, then, to come to you. So you've described yourselves as venture builders. Are you as patient as maybe sort of other forms of finance or kind of investment partners might be, or does that change your timeline or your timetable at all?
Certainly can be very patient. So Blenheim Chalcot's been going 20 years. We've started about 40 companies. There are a couple that were there from the beginning that are still part of the business. So it's 18 years in, and money is still going into the business and growing them, and exit hasn't been the right thing to do yet. And other businesses have exited very quickly when the right offer has come at the right time for investors and for management. So yeah, certainly the patience is there when it's appropriate.
Right. Speaking of that, though, actually, in the sort of spectrum that you have, you had an exit last week.
Yes.
There's a clear score. And so that life cycle was actually quite compressed or accelerated, wasn't it? Do you want to talk about what sort of contributed to that?
So ClearScore was a business that we helped to found about 3.5 years ago. It exited last week, or it was agreed to be exited subject to regulatory clearance to Experian for £295 million for a business that launched less than 3 years ago. So I think that's a real testament to how fast a business can scale and grow if the distractions of constant fundraising and some of the administrative issues around recruiting and R&D tax credits and sorting out your property and all the things that most startup businesses spend a big chunk of their time on. So, so definitely that's, I think, a real testament to if you get the right investor that can support you with stuff beyond money, they can help you move faster, as Rhydian was saying.
Okay. And then Chris, you have this point of view from being a sort of industry commentator, and so you get to look from afar and sort of, for you, it must be hopefully very straightforward about, those are the mistakes that they're making, or they're continually being made, or the pitfalls. And from where you sit, and obviously you also look across all of the UK, so not just London, and you also probably compare and contrast to other FinTech hubs. What do you think are sort of the best points of value that capital can bring for a FinTech enterprise?
I mean, to a large extent, there's never been a better time to launch a startup because it's so easy. And it's easy because you've got cloud-based services, so you don't need to invest in a high capital stack of technology. And what's interesting right now is that there's massive opportunity arising everywhere in the world. So I was just in Rwanda a couple of weeks ago and bumped into a company I'd never heard of, but it's Africa's first homegrown FinTech unicorn called Craft Silicon, which is a company that provides mobile network operators with mobile wallets and mobile payment services. And I think that's the key thing, that wherever you are in the world, there's opportunity, and it's how do you grasp the opportunity. And that's down to the leadership and the management and the founders and their vision. And often, I think the biggest mistake is what I see as FinTech being just fin or just tech. So I see a lot of visionary young people who are founding new ventures and can see the faults of the financial system, but they don't understand why some of those faults exist, and they exist for very good reasons sometimes, as in KYC and AML and the whole regulatory burden that goes around that. And then as they learn that, they normally end up bringing on someone who's what I would call more of a parent figure, an older person who has been around the circuit and understands the markets. And that's why I think of FinTech as being parent-child. So the parent wants to keep everything stable and robust and nothing changes, and the child wants to destroy everything. And that's kind of marriage of FinTech. Well, I think the mistake is that if you only have a parent or only have a child, you don't have a balance. And you need that diversity. You need to have good diversity in the team.
Okay. It's probably true for not just FinTech as well. Yeah. I think this might be a good time, actually, because I could continue asking a million questions. I want to just actually check with the room. How many people sitting here are entrepreneurs or are the heads of FinTech concerns, SMEs or otherwise? So it's actually, I don't know what you guys say, like 20% of the room. It's not really a majority, right? How many are investors? About the same. Okay, and so first of all, for either constituent, I think if you have any questions, given this esteemed panel, please put them into the app, because I am paying attention to the iPad and I will get to them. But then I also think, given that balance, that there's equal number of investors as well as entrepreneurs in the room, one thing I'd love the panel to reflect on is, either as entrepreneurs or also as you've advised companies, how important do you think financial services expertise is in an investor who's bringing capital, rather than, say, just the capital or maybe other strategic value that they might be able to lend, whether it's network or access to business development or otherwise? And maybe if we can start again with Rhydian or Steve?
Yeah, I think it's very important. I think your investors are more than just capital. They are a network, they're intelligent thinking, they're a sounding board, they're a business partner, they're all of these things. And if you can leverage that and have sometimes a different perspective, some of the thought processes that we've seen some of our investors go through over the various fundraising rounds that we've done are just incredible. Just a completely different way of thinking in certain circumstances, and just having the different perspectives that they can bring is enormously valuable.
Okay.
I think it's fine if you have flexible minds. I actually think that it's fine, whoever you have. I mean, because there's definitely a certain code to thinking in financial services, and I suppose one of the things that FinTech's trying to do is to reimagine some of that. And elements such as, I think a lot of fintech businesses are predominantly leveraging technology, and there's no risk management per se in the product. And I think you can have any mindset in that, frankly, because I think that's veers towards has similar characteristics to a lot of other companies outside financial services. I think in some of the areas of fintech that involve risk transfer, as in that the product involves risk, I think there is a kind of browbeaten kind of parent figure that has seen all the kind of ups and downs before and understands that the relationship between risk and reward is totally immutable and is never going to change in terms of one follows the other. But that's not to say that you need financial services experience at the top, because a fresh mind can get their head around that, and sometimes perhaps not having that kind of wearisome kind of fatality to it, or fatalism, should I say, can give a little bit of a kind of tailwind for a period of time that's crucial. So I think open minds, as long as they're flexible minds, I think can do this.
Doesn't necessarily need that industry expertise. What about you, Dan? You obviously must be able to bring great financial services expertise. Do you find that's been really helpful for you in trying to sell your capital in?
I think it's one of the things that can be useful, but it's by no means the most important thing. I think one thing it's easy to draw the impression of when you look at these amazing panels all day is that all fintechs are successful. But if you look at the stats, then the majority of fintechs that receive at least some professional funding will be dead within a couple of years. And if a fintech has been backed by a business that you know has a long-term track record of sticking with their businesses and supporting them through the tougher processes and making sure they're there for the long term, that makes them a much more attractive organization to partner with, because no existing bigger organization wants to partner with a company that's going to be disappearing if the next round of funding doesn't come through. And so one of the great things I think an organization like Blenheim Chalcot brings is the credibility to be able to go into partnership conversations with much bigger organizations where they have the comfort of knowing that we're going to be around supporting this business long term. And so we've got businesses, a couple of years old that are partnering with organizations like WorldPay and Big Five high street banks, Legal and General, Countrywide, and so on, where similar standalone organizations or ones that are funded through more traditional routes would struggle to convince those companies that they are healthy partners to have a long-term relationship with.
Okay. Chris, I'm going to come back to you in a second, but I want to take something that Dan said and actually put it to Steve. You mentioned the word credibility, Dan, and I think when we were talking earlier backstage, Steve, you were talking about how even in your most recent finance, or maybe it wasn't your most recent, but one of your later rounds of financing, so not even early on, and you were already established as quite a dominant sort of player, getting certain members of the ecosystem involved in certain brands, can you consider relay that value for you?
Yeah, absolutely. When we announced the D round with Google, it's incredible how misreported that was, actually. It was Google Ventures, not Google. But the people that came crawling out of the woodwork wanting to open up a conversation that they had closed the door on 2 or 3 years prior just because Google had invested. But it's all the credibility. It's like, well, these guys obviously serious players now, and it's incredibly helpful. Incredibly helpful, but it's not a silver bullet. You still need to actually deliver the product, deliver the service, and do the deal. But just because you've got a decent name on your cap table doesn't do the work for you, but it just makes life an awful lot easier, as I think
well, and you have to sell them in the first place. You had to get them on board, right?
Yeah.
Yeah. So Chris, that would lead me to ask you then, from what you've been watching in the ecosystem, we talk about a Google or someone who's not a financial services specialist, and we've heard different sort of comments on whether or not that's necessary or otherwise. Do you see lots of other people coming in and trying to invest in fintech that surprises you, or that you think is different than maybe 5 years ago, say?
Oh yeah, I mean the market's nuances are changing and flowing gradually, but there's been a big difference in the last couple of years in particular. And in 2016, I remember saying that the stats were about $100 billion invested in fintech startups in the last 4 years. Now it's $133 billion in the last 3 years. So the money's growing, and where is it coming from? And a lot of it is coming from the fact that the fintech marketplace is much bigger. it's growing deeper and broader than ever before, with the nuances of wealth tech, insurtech, regtech, and obviously distributed ledger technology and artificial intelligence, machine learning, and all the buzzwords that we have to throw in. But they're not just buzzwords, they're real things happening. And I think the biggest nuance change in the last couple of years in particular is the banks themselves and the corporates and the institutional investors are noticing this marketplace and starting to partner and invest in co-creating new models and new capabilities. And although some of the institutions are just paying lip service to that and showrooming, there are some banks that are seriously creating traction around how to take innovations outside and bring them inside and work with these companies and actually make them grow quicker. And I think that's been something probably that spawned out of maybe things like the FCA sandbox. Right. And that if the regulator's encouraging innovation, supporting startups, and encouraging the banks to partner with them, then that changes the actual culture. And I think that's what I've seen, particularly in the last couple of years.
Okay, brilliant. And so looking back on what's happened in the last few years and how the ecosystem has matured, let's look forward now for the next 2 to 3 years. What do you think is the biggest threat then to, we're all sitting here because the UK is obviously one of the global hubs. What do you think is the biggest threat to that? Or do you think we're just going to keep going from strength to strength? And now I'll start with Chris and go back the other way.
I think it's going to keep going. The real fundamental that's happening here is that technology is dramatically changing everything, as we know, and it's only 70 years old, and it's moving forwards. And what's happening in financial markets that have been immune to a lot of these changes until recently is that the reimagining of finance with technology is starting to come through. And so, I know that Ant Financial have been talking here and presenting here, but it's fascinating when you look at their business that they are building a platform that will support 1 million transactions a second for 2 billion users in their current architecture, which is phenomenal. I mean, Visa does 2,000 transactions per second. These guys are doing 1 million a second, and they're small transactions, and they're not just in China because it's 2 billion people. It's all over the world, in India, Philippines, Indonesia, Europe. So for me, it's starting to say the imagination with technology that's been unleashed in the last few years is just going to get bigger and bigger over the next few years. Okay.
Dan, I'll go to Dan and then Rhydian next.
So I think London's going to carry on being a great place to be, FinTech and in all sorts of other tech. I think the one thing that I'm starting to see change more and more is that the providers of finance are looking to provide more value add around the finance. So more of the big VC companies are hiring talent partners and growth partners and people that can insert their expertise into the organizations that they're funding. So they're competing on a broader range of value add. And I think that's only good for the entrepreneurs that they're funding because it will help them to be more successful. So I'm very optimistic and bullish.
Okay, Rhydian?
I think the cycle of exits is very important. I mean, there's one. I think it's clearly that the technological advances being made are unstoppable, and it's kind of who's going to actually capitalize on that, who's going to bring that to market, because it might be that banks actually do that as effectively as fintech companies themselves. But if some fintech companies go the whole way and actually become successful exits, like Dan was talking about, but also fully through to IPOs and therefore are tangible, visible success stories for people, I think that makes a big difference because suddenly investors really believe that it can go the whole way. People want to work for those kind of things, and they're no longer technology players, they're actually companies that have been successful. And I think we're probably a year or two away from having that in the UK, and that would be absolutely terrific. I think because people can point to companies rather than just technologies. Yeah,
okay. Steve?
Yeah, I think you can see more of the same. I think FinTech isn't going anywhere. I think you're going to see more and more entrants. You're going to see more collaboration. There are so many FinTech companies now. Echoing Dan's sentiment, you are going to see some fall by the wayside, an unfortunately high percentage, I think. But collaboration, I think, is the key to moving forward. You're seeing that with open banking. It's been driven by PSD2 in the EU, but open banking is a global phenomenon. My learned friend, Mr. Skinner, I'm going to steal one of your quotes, is like banks do 1,000 things okay, but there are 1,000 fintechs doing one thing really well. But if you put those together and create a more collaborative economy, I think you're going to see that I think is going to just become more and more prevalent.
Can I just say one thing on collaboration, because I think that's a very that's been a word that's become very current in the last couple of years, but I also think it's worth stating that we are in direct competition as well with the banks, and therefore there's no point in being mealy-mouthed about that, and that one needs to be ambitious on that point and say, they do a lot of things that we're looking to do, and that competition is important as well as collaboration. And I think that because the theme quickly becomes about collaboration, and sometimes that can mean that the landscape won't look that different to the man in the street in a few years' time, because the same brands will dominate. Whereas I think in competition, you might see some brands that actually emerge. I just put that as an alternative to...
And that's one of the things that I keep doubling down on, which is that the biggest challenge right now in the next decade is for the bank's cultural change to embrace collaborative competition and to start looking at all of these 1,000 companies doing one thing brilliantly well with APIs as something that they can curate to their customers, because the customers aren't going to try and work with 1,000 startups. But having said that, if the bank can bring those to the customer and give a better customer experience, that to me will be the change. But a bank typically doesn't want to do that historically because they like to control everything. As you know, it has to be secure and risk managed and internally organized. But opening the bank to a collaborative culture, and that's what to me open banking really is. It's not technology, it's cultural change to be open to collaboration.
And I think that the nature of competition between the banks will shift to which bank can be seen to be the best partner for the fintechs, and that will be a source of competitive advantage that we'll be fighting over.
Okay. So I have far too friendly of a panel here, because you're all emphasizing patience and collaboration, and nobody mentioned Brexit or any possible threat to the UK's sort of dominance in fintech over the next 2 to 3 years. Is that accurate?
Oh, well, I'd say unless a company emerges that actually can be a company that is new and becomes a success story, as opposed to, as I say, just technologies that get embraced and absorbed, whether it be through banks or other things. I think that the risk is that the landscape actually looks the same to the person walking down the high street in 5 years' time as it did 10 years ago. Whereas in other countries, you have seen startling success stories of companies go very quickly and control the customer relationship within 5 or 10 years.
Okay, sorry. So I see your point. You're sort of saying this hub could remain a hub for enabling technologies and just facilitating the existing financial services sector versus having developed commercial concerns and sort of new brands and new institutions that consumers will do with.
Yeah.
Okay.
And to your point on the UK, obviously there is that sort of elephant in the room of Brexit, but no one knows what it's going to look like.
Right
yet.
out there.
So,
yeah.
Is it a small elephant, a big elephant? You know, is it Indian or African? I don't know. But to me, what I keep finding is, you know, although Paris and Berlin and other places might be desirable and competitive with London, the talent pool, critical mass here is very difficult to find anywhere else. So what I'm hearing from most companies is if they're going to worry about Brexit, they'll create two-centre approaches and maybe have a centre here and a centre in Estonia or in Dublin or somewhere else. Hedge, yeah.
Okay, all right.
Yeah.
And I did warn that I run the risk of asking you guys questions all day, every day. I will, in order to get at least one question in from the audience, pull in something that we have already started to talk about, which was whether it was Google, whether it was banks, or existing financial service institutions. I think it was Dan that mentioned it. Somebody was asking if you could please lend your advice on the merits or pitfalls of raising from corporate investors or strategic investors, and whether or not that's recommended or you'd caution people against that. Anyone want to weigh in?
So one of our businesses is called Salary Finance. It's an employee benefit that lends to the employees of big companies and takes the loan repayment straight from payroll, so helps reduce interest rates. Launching that is a business that needed to sell into relatively conservative HR departments of big companies. When we took in corporate investment from Legal & General, immediately there was a tick box on the company slide deck that said Legal & General has been all over this, they're safe as houses. And so that was, there was a huge piece of additional value that came alongside the money, which was this flag of endorsement. So on top of that, Legal & General have been helpful in introducing us to their clients and so on and so forth.
Right.
But definitely that kind of strategic money with that value add was very helpful.
So again, the credibility.
Yeah.
Anything else to add?
I think it very much depends on what stage your company's at. And you need to think long and hard in terms of what you want to achieve out of CVC. If it's just cash and the company's going to sit in the background, that's one thing. But there is a risk if you're an early stage company of developing a product or a service that works for one customer, and that leaves you awfully exposed if that doesn't work.
Yeah, I mean, I think it restricts your ability to do the favors pivot, which is an important card to have in your back pocket in startup enterprise, I suspect, because you probably bake down a strategy. But
I think you're right. You need to know exactly where you're going before you get locked in those tramlines by a corporate partner. Yep. Yeah.
And a very quick answer is to Steve's point. It depends what stage you're at. In that I've been with a couple of startups that have refused corporate money, and then 6 months later they've run out of money. So take it when it's there if you need it.
Take the money first. Yeah, be fussy later.
Yeah.
Yeah.
Brilliant. Okay, and sorry again that I probably rambled on too much or had too many questions. We didn't get to more audience questions, but we have run out of time. So I just want to wrap up by thanking my panelists for all the different points of view. We really could have a whole conference, I think, between all the different sort of members of the ecosystem that you represent. But congratulations to entrepreneurs on your great businesses, on the venture building that you've been doing, Dan, and also on your new book that's coming out. So please join me in thanking Chris, Dan, Rhydian, and Steve.
Thank you.